Well, the Labor Department released its weekly jobless claims report this morning, and the numbers show American job market still holding strong. 200,000 workers filed for unemployment benefits for the first time last week. That's better than experts expected and near the lowest levels we've seen in roughly 50 years. On top of that, the number of people continuing to collect unemployment also dropped, hitting its lowest point in more than 2 years. Here to tell us what all of this means for you is Jeffrey Small, partner at Retirement Income Source. Jeffrey, good to see you again. So the numbers look good on the surface, but you described today's jobs market as shifting from red hot to stable but slowing. What does that mean?
Well, the labor market right now, Alicia, really is becoming a low hire, low fire economy. And companies are cautious, but they're still holding on to workers. And so continuing claims actually fell, which is good. That suggests that displaced workers are still finding jobs relatively quickly. And the current jobless claims report today really reinforces the idea that the economy is slowing but not collapsing. And that's exactly the soft landing narrative the market wants to hear. The Fed probably looks at this report and says, we still don't have enough labor data or weakness to justify any aggressive rate cuts.
Yeah, okay. That was my next question, but we'll move on because we don't know what's going to happen with the rates yet. We're hearing more about layoffs at big companies, especially in the tech industry and the AI, especially driven sectors. How much longer can low jobless numbers hold up like this? What are the warning signs we should be watching for?
Well, we don't have any real warning signs yet, other than there's lots of employment movement going on between companies and companies, lots of people leaving one job to upgrade to another job, because clearly there's not enough qualified people in this country. We have 8 million jobs outstanding, and we can't seem to get them filled. And so I know that headhunting has become a huge business now, and pirating other employees to come to another company with better offers. And so that's going to keep happening. But let's not forget the age wave now. We've got 2 people retiring for every 1 person entering the workplace today. And so that's putting a premium on employment at this time and gives us this very even-keeled approach. So unless we see an economic downturn, we don't really see layoffs accelerating, even though there has been some mild cost cutting in the S&P 500 companies.
Okay. Wall Street has been on a wild ride. We've seen this on again, off again, war and peace headlines whipsaw the markets. Critics say the people benefiting most are not average Americans. It's well-connected investors with money, lots of money and information to move before everyone else does. Is there any truth to that insider trading concern?
Well, I mean, there might be a shred of truth. Insiders have always reacted, the ones that can, but markets have really become politically hostage to the geopolitical issues. We've become hostage to their movements. And so, one comment on tariffs or war or sanctions can move trillions of dollars in minutes. The algorithms and institutional trading systems, are amplifying every geopolitical headline into massive intraday trading swings. And oftentimes, Alicia, retail investors feel like they're trading against a market that reacts so quickly that we really don't have time to react. And so whether regulators see wrongdoing or not, is important, because we want to make sure that the retail folks have confidence in the markets and the investment playing field is even for all of us.
Yeah, it seems to be people are still seem to always be on the right side of the trade. Funny thing. Jeffrey Small, partner at Retirement Income Source. Appreciate your time and insight today.
Thank you.